And we're officially live only on onedealaway.com/live. My name is Nev. This is Money Matters, and we broadcast live every morning at 7 a.m. Eastern Standard Time or Eastern Daylight Time, only on onedealaway.com, as I have mentioned. And in today's episode, it is a Monday, so happy Monday to you. It is August 3rd. We're officially getting closer to the fall and understanding what waits for us on the other side of the whole thing. So today we actually have all kinds of very, very important news. We're going to obviously take a look at the market because we haven't done that in a little while. And then we're going to actually go in and learn a little bit about what's been going on with the treasuries. They are dropping. Are they going up? What's going on? Where can we expect some of the things to kind of move and shake? Why is everybody going bananas all over again? I've also discovered a bit of news and information that something very, very interesting is happening with mortgages. And even though we do our regular report on real estate and mortgages on Thursdays, I didn't want to wait till Thursday to share this very, very important news for you and with you because you might be right there going and looking for stuff, and I want to make sure that I share with you the good news as it happens. So there you go. As you can see, we're going to see all kinds of very, very important stuff. Finally, we're going to be talking about, all of this stimulus and all of this debt. How much is it really doing for us and what's going on? There's some other additional components that you might want to hear about, and that is some additional products that are coming your way that you can trade. And in my personal opinion, it is the worst thing on the planet that is coming in, and unfortunately, many people will jump in it right as it's about to nosedive. So there you go. If you don't want to lose everything you've gained trading all of the broke companies, then you definitely want to watch today's episode to learn what's coming in the market and how to protect yourself. So let's do this. And good morning. I hope you're excited for Monday. There's nothing better than an amazing Monday. Although, when you work and live and do everything from home, I guess every day looks exactly the same. It's only what you can do with this and with this that makes all the difference, y'all. So there you go. That's my that's my yogi moment, I guess, for the moment. All right, let's take a look at the markets, y'all. So here we go. Dow Jones, Friday, I mean, it was a nice little U formation. You know how much I love those. But a 5-day, no, not so bueno. Not so bueno. As you can see, we're definitely tapering off, and it's not looking that it's going to go anywhere great. S&P 500, very similar chart again, but 5 days is actually in a positive. On the 6 months, we're actually in the positive S&P 500. So way to go, S&P. But, I will explain why that might be happening. NASDAQ did pretty well. As usual, 5 days is up. 6 months, we know it's up. 1 year, we know it's up. 5 years, we know it's up. It's been up, up, up. So NASDAQ keeps on chugging along. Gold is actually, kind of down right now as of 6 a.m. I guess, but the price is up since we checked it last time. As you can see, it actually climbed up to, it actually touched up on the 2000 only to come down slightly. But I do expect that we will be well over $2,000 by the time September comes. So August is going to be a very exciting month for folks that are in all kinds of different assets that are non-mainstream, as I like to call them. Silver actually has performed really well as well. As you can see, it's up on the day. We've actually hit a little bit of a high here and there, but it's the metal is definitely moving nicely. Treasury yield is down and down and down and down and down. Down is the story for 10-year treasury, and there's some news that actually I'm going to share with you about the treasury. Euro USD, it is down, and but we are up over the course of 6 months. Volatility index is down, and it has been down for about it's been coming down ever since the March piece, but it's starting to slow down in the down motion. So that is something for you to see and understand, right? You can see kind of how it does the peaks and stuff. And look at this guy. I mean, this was not so, completely not so. Bitcoin is doing really well. If you recall, it actually hit on up well over, I think we touched 12,000 or something like that. And then it kind of had a little bit of a micro crash. And then it's been sort of going a little bit of a sideways motion. But overall, Bitcoin is doing okay. Okay. And okay is okay, right? And of course, it all depends on when you've actually, invested in it. For those that have bought at a penny, they are still sitting very pretty. For those that bought at 20,000, well, they are still waiting to actually turn from red into green. So congratulations if you have actually made money over the weekend. And there are definitely some coins that you can buy that might not necessarily have to be a Bitcoin per se. There's plenty of crypto out there, plenty of ways to invest and to make money. And like I said, even without going into the mainstream markets, meaning the same old stuff: stocks, bonds, mutual funds, and ETFs. Speaking of stocks, bonds, mutual funds, and ETFs, we actually have some very, very important news that I'm going to share with you when it comes to stocks, bonds, ETFs, and some of the things that are coming in. And we're going to get started with the 10-year treasury yield, which actually plunged to its lowest in 234 years, y'all. 2.5 centuries. If you've ever wanted to live in a time where history is made and times are interesting, well, you've chosen the most excellent time on the planet. 2020. Congratulations. I know you're thinking, like, I didn't choose it. Now he chose me. I'd rather not. But look. Before we go here, I do want to pause for just a moment and share something with you. I know that the situation is very dire, right? And we're talking about, people without jobs, people without money, people that are about to be evicted, all these different things. But every downturn is also an opportunity, right? It's the same coin, just different sides, right? It's the same phone, right? Just front or back camera. Which one do you want to look at? Okay? So my challenge to you is to really look at all the good things that actually have come out because of COVID. And I know you're thinking, this guy's crazy, I'm shutting him off. And that's fine. You can leave. You can shut it off. You can boot me if you want to. That's fine. But I think if you really critically take a look at some of the changes and innovations and movements and changes in thinking that likely you have experienced, that everybody else has experienced, and businesses experienced, I think you will find that there's some really good things that have come up. And if you think even further and even harder, I am sure that you can come up with additional pieces of how you can make it even better. Let me give you an example, right? In a world of medicine, right, we always used to believe you have to go into the doctor's office for them to just talk to you, right? You couldn't pick up a phone and talk to your doctor just to ask a silly question of like, hey doc, this is what's going on, right? Like, it's not anything that you have to be examined. Like, it was just literally a conversation other than like prescribing your like renewing your prescription or whatever. But now we have a thing called telemedicine, and it works really well, right? So that's another piece that is kind of, that's one piece, right? We used to believe that the only way that the businesses and corporations could be successful is if everybody sits in a same giant office in some sort of weird cubicles and stuff and shouts over each other. And we are realizing and learning very quickly that that's not the case. We can work remotely. You can sit on a beach, sip a Mai Tai, and still be very, very productive, probably even more productive than you're in the office. And then you can take a pause, and instead of walking over to Bill's office or cubicle, you can actually go jump into the ocean, go for a swim, come back, dry off, go back into your laptop and continue working, right? Those are amazing things that we have discovered. We have discovered that we can actually, live and survive a pandemic, and we are living through and surviving it. Those are really, really positive things. So I think that if you look at your own personal lives, there are going to be some many things that you think through that have changed kind of how you behave and how you think. And hopefully that changes for the better, not for the worse. So when we talk about some of these things of, well, the yield is plunging down, and the market is struggling and all of that stuff, you can bet on the long side, you can bet on the short side, you can buy, you can sell, you can hold on to it, you can accumulate. Part of it is just really about looking at what makes sense and how to actually set yourself up for all the changes that are coming, right? I've been telling you that this is going to happen. I've been saying that the interest rates are going to continue to drop and the mortgage is going to drop. I've been saying that we can expect that the market is going to pick up in summer and fall. I've been saying that we're going to, and I am saying that we're going to experience way lower prices in the upcoming years in real estate, which could position you in an incredibly great way. And people are worried about hyperinflation, but I'm excited about it because when we get into some of these assets that we're talking about here, hyperinflation, come on over, because all it does is eliminate our debt, leaves our assets alone, and we can survive through it. So if you are excited about thriving and potentially not just sort of like, holding on for the dear life and doing everything that everybody else is doing and then getting basically carnaged with everybody else, I do invite you to continue staying with Money Matters channel. And welcome to everybody watching this live. Good morning, and welcome to everybody watching this on YouTube right now. Make sure you do subscribe, please, and thank you. If you're interested in the content and want to continue sticking with us, I also suggest that you come and check out the live feed every so often if you can, but I understand not everybody can. And do me a favor, smash that like button if you're watching this on YouTube, letting me know that you are watching and enjoying. All right, now on to the thing. I'm done with my little rapping, whatever thing. Okay, so what is going on? I love it how they put some of these fun pictures and stuff when you're it always makes me laugh. I get it, but it's funny. Like, come on, whatever. The 10-year Treasury note fell as low as 0.520 in overnight trading in early Friday, matching levels last seen in March 9th, when the benchmark maturity rate to an all-time low after worries about COVID-19 pandemic sent investors scurrying into safe haven assets. According to Deutsche Bank, this record low stretches further back than most might expect. The calculated current downfall in the 10-year went back 239 years. Take a look at this thing, y'all. This is 1786 here. So, this is like way, 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 way back. And look, this is where the yields were over here. 25% in 1780s, 1790s, whatever. And then it kind of plummeted, and it's been sort of downish and downish, and then we had a nice little peak in the late I would say, what is that? That's the 80s, early 80s, right? Like late 70s, early 80s. And we've been going steadily down ever since. So this over here, what is interesting for me when I look at this from 1786 to 1946, it was in the yield was in a downfall turn. Now, it wasn't as steep as this over here, right? But it was, look, it was down. It went somewhat up and down and stuff. So this is a very interesting piece for me because, a lot of times we hear about folks saying, the bonds could not possibly stay this low for forever. Well, if you were to take a look at it, I don't know, if this is 1786, maybe this was 1790, I don't know, whatever, right? Like late 1700s, let's just put it that way, all the way to mid 1900s. That's what, century and a half, right? 150 years, it's been sort of in a very slow downward motion. So when people say, well, this could not be happening for forever, dude, you haven't looked at for forever. Look, I'm talking about 150 years. So I think that that is one of the interesting pieces that we should keep in mind when people say, well, you can't really do this stuff for forever. Well, you can't do it for forever, but it sounds like you can do it for what? 150 years plus minus, and that's just a historic what we could see over here. Who knows, maybe that record could be broken. I don't know. We probably won't be around to see it and witness it, but maybe this video is going to be held in archives somewhere, whatever that looks like in the future, and somebody might stumble across it and be like, yep, they were right back in 2020. This is like, 2350 or like 2400. I don't know. I don't even know if the world is going to stay that long. So we'll see. We'll see. The relentless slide in the 10-year note reflects how the bond market's bull run has defied prognostications by pundit that interest rate and yields would eventually rise, right? And that's exactly what I'm saying. Everybody says, well, he has to come back up. No, he doesn't. No, it doesn't. It doesn't have to do anything for a very, very long time. Now, there is a challenge with this whole thing, right? So the yields have actually dropped to the lowest they have been in over 200 years, right? So that's an interesting piece that you should be aware of. Now, the second piece that you definitely want to know is that the U.S. yield dropped to -1 as economic outlook darkens. So real yields on U.S. Treasuries hit -1% on Friday, reflecting investors' willingness to pay for safe assets, right? So this is all giving us a very, very clear picture that people don't want to necessarily go as much. I mean, they're getting into the risky assets, and risky assets are considered things like stocks, right? Equities are more on the risky asset. Cash is more on the safer asset. We could argue about the safe and risky, right? I fully acknowledge. I'm just giving you what the traditional way of thinking is, okay? So equities are risky. Obviously derivatives are very risky, right? Derivatives are very risky. Equities are risky. I believe that the cryptocurrencies are considered to be in the risky category as well. Things like gold, things like bonds and cash are considered to be safer, or the safer side of things. Real estate is interesting one because they don't necessarily talk about it, but it's kind of seen this sort of a weird piece of like kind of risky but kind of safe, but kind of we don't really talk about it and stuff, because when we talk about assets typically in the news and stuff, everybody just talks about what? A couple of things: stocks and bonds, stocks and bonds, stocks and bonds, gold, stocks and bonds, right? So and now of course Bitcoin every so often shows up, but there's so much more to cryptocurrencies than just Bitcoin, right? And there's so much more to investing than just the Wall Street casino that they peddle all the time. But anyways, we shall continue. We're gonna cover all of these different things. So we talked about the real yields have hit -1%. The decline took real yields to a level hit only on the onset of the market turmoil in March. So one of the things that I want you to sort of pick up, that I'm actually picking up, is that the first article we read is, wait a minute, this has never happened unless early March. Then now this article is saying, hey, we're seeing now for the first time again, this happened in early March. We're seeing some of the stocks is kind of like starting to sort of look topish, so to speak, right? So there's a lot of things that are saying, wait a minute, a lot of things are mentioning early March, early March, early March. So are those signals? I don't know for a fact, but it is very curious to me that we're seeing a pattern repeat just a tad. So I definitely am watching it, and I'm very interested and curious about it. And so we'll only see, right? I mean, I don't know. My crystal ball broke years ago, so I don't know how it goes, but it is very curious to me that we're quoting early March time and time and time again today. The decline in real yields achieved using inflation protected treasuries reflects traders' expectation that the US central bank will not raise interest rates over the next several years. And I agree. Traders are now betting that the Fed won't raise interest rates until at least 2023, according to the futures market. Futures for the 10-year note were settled at their highest price since at least 2003 on Thursday. And you know what, I agree with the article. I don't expect that they will raise it for a while because if you watch the Jay Powell talk about it. Now, again, he's not going to be a chairman for forever, right? He could potentially be replaced. I know there's some conversations about a lady coming in. I can't remember her name. So if you do, let me know in the chat or the comments. But so that could change, right? But you know, we have a presidential election, so that could also shift some stuff as well. But you know, right now they're sort of saying, well, we're not going to touch it until the employment numbers go up and until things improve in economy. Well, that ain't going to happen anytime soon, right? To basically to lose all these jobs, it's very, very fast, very, very easy. To gain all of the jobs, not so much. And if you know, Biden kind of comes in and increases taxes onto everybody, I have nothing against him. I just don't agree with the increasing on the taxes on anybody. You know, we could see actually a really bad economy turn even worse. If you can believe that it actually can get even worse than where we are right now. And so that's kind of where I can see this potentially going. So, you know, yeah, I could see the, you know, mid 2020s before the rates are even touched, if not further down the line. So I don't expect that the rates are going to go up anytime soon. You know, I know that they're saying 2023. I'm thinking 2025, 2030 even. So I really do think that entire decade of super low rates, unless something, you know, obviously big major happens that I can't even predict, right? I can think about it, but I can't predict it. Now, we talked about many different things over the last week and so on. And one of the things that we've talked about this right before we went into the weekend is real estate stuff. And I have been saying for months now, right? Hold on. If you can hold on, these rates are coming down. These rates are coming down. And just last week, I want to say, or maybe week before, so check me if you remember, because I don't, but I know I talked about it. I have said I do expect the rate below 2%. Check it out, y'all. Boom! UWM now offering 15-year fixed mortgage rates as low as 1.87%. What? Unbelievable. So United Wholesale Mortgage announced on Friday it is rolling out a new loan program that offers borrowers an interest rate as low as 1.875% for both purchase and refinance. This is a record low, and this is what I've been saying. This is what I have been expecting and waiting. And if you remember, when we talked about UWM, you can't, like, it's not a bank where you can go in and be like, hey, I'm here for one of those 1.875% mortgages. It doesn't work that way. You have to work with the mortgage broker, right? But the good news is with this is that they're sort of they are the largest mortgager, and so they tend to be the leader of the pack. As they go, the rest follow. So now, if you give it a little bit of time, you're going to start seeing dwindling down rates, and so that 30-year is going to hit low twos, low to mid twos, as opposed to low threes, high twos. So it's going to hit low twos, which it has already, and I do expect it to go even lower, if you can believe this. Now, I could be wrong. Yet again, I always tell you I could be wrong. I don't know anything for certain, but I'm just looking, right? Everything is tumbling down. The expectations are tumbling down. People don't want to go tumbling down, right? Real estate is this like really weird, wonky asset thing that nobody can figure out. Is it safe? Is it risky? I don't know what's going on because it's not liquid. It has a lot of risk. But but because it has been protecting wealth for centuries, it also could be potentially safe. It just really depends on what the future holds. Inflation, deflation, hyperinflation, hyperdeflation. I don't know what's going on, right? All of those pieces will play a big part on it. And so that's where kind of weird piece is. And for vast majority of individuals, when they think about real estate, they think about they buy a home and that's an investment, but they live in it. But that's not an investment. That's just a home. When the other people think of like, oh, I'm investing in real estate because they're buying REITs, they're buying ETFs that is kind of following the market and stuff. They are crowdfunding on Fundrise by like putting $100 and so anyways, right? So it's a very, very interesting marketplace, but this is an interesting piece for you to understand right now, that I do expect rates are going to kind of stay low and potentially go even lower. And I could see that, as we've seen this surge in people wanting to go out and buy some of the homes, right? That's starting to slow down. We've seen some reports that is slowing down right now, right? And we can see that potentially to slow down even more. And we're seeing that some of the sellers are like, it's going well. Maybe I should start kind of coming out of woodworks and start selling now. So it's something that we should be definitely watching. As the number of sellers kind of slow down, they drop the rates a little bit lower, more people jump in, we continue on going. So that's what I'm saying. I do expect, because rates are not going to, interest rates are not going to come up. I do expect that some of the mortgages are going to actually drop it further, because, you can earn 0 or you can earn 2%. How much would you want? I'll take 2. Thank you very much, right? So that's exactly what they're doing right now. It's just a big old giant shell game. Those eligible for conventional mortgages are eligible for the rate. In May, UWM rolled out a new loan program that offered borrowers an interest rate as low as 2.5% for purchase and mortgage and refinance, and everybody else followed suit. Then in June, they announced a new VA loan that offered rates of 2.25, and many other follow as well. Now they're rolling this puppy out. Rate below 2%. Did you ever, in your entire life, ever think that we would hit a below 2% interest in mortgage? I bet you didn't. And I bet you thought that when I said I expect this to hit 2 or below 2, you thought I was probably nuts. Now, maybe I have a little bit of respect from you. I don't know. Maybe not. Maybe not. Okay. All right. So here's another thing that is also happening with the low rates. Hold on. Another thing that is also happening that is very interesting with the whole low rate stuff is that stock buybacks are back with vengeance. Tech stock buybacks are surging, right? Let me see if I can make this bigger. This is super tiny. All right, here we go. Much better, although now it doesn't fit on the page. Never mind. Just kidding. Maybe. All right, yeah, we'll keep it like this. Okay. While total buybacks are indeed expected to drop this year as the downturn caused by coronavirus saps corporate profits, companies in the S&P 500 that have reported second quarter earnings so far have reduced the number of their outstanding shares by an average of 0.3% from the previous quarter. Some of the largest U.S. multinationals continue to buy back their own stock or even accelerate stock repurchases. Surprised? Yeah. Yeah. Interesting. Alphabet, right, the Google parent company, as they're known, which spent $6.9 billion on buybacks for the quarter, up 92% from year prior. So they almost doubled their purchases of what they are doing right now, right? And so now if you think about when we looked at that S&P 500 index chart and stuff, and it was doing better than the Dow, and now you understand that, wait a minute, they're cooking the books again, right? I mean, they're not cooking it. It's legal. I don't think it should be, but it is legal. And so that's stocks are going back up and they're calling on to it. And y'all, Again, manipulation, manipulation, manipulation. Uh, Microsoft purchased 5.8 billion of its stock for the period, up 25% from the year earlier. Biogen spent 2.8 billion, right? There's a bunch of other ones. The biggest source of buybacks was once again Apple, which purchased 16 billion dollars in the second quarter, and that was actually down 6% from the period last year. So there you go. Here is the figure of S&P 500 sectors bounced buybacks. So energy, not much. Industrial, coins, distribution, nothing. Staples, nothing. Telecom, nothing. Utilities, financials, we have some. Materials, definitely some. Healthcare, yep, right there, like materials. And then tech is much, much higher. So there you go. And interesting piece is that you also will see the percent of market cap, and you will see that all of them are buying more than the market cap, except for materials, which is below the market cap. Berkshire Hathaway plowed about $5.3 billion into stock repurchases during the quarter. The buybacks have staged an impressive rebound as shown. And here you go. Here is the chart. The green little line is dividends. The red-ish, blackish, whatever, brownish, I don't know. The non-green, let's call it the non-green line, is the buybacks. And you can see it hit super high, right? And then we've kind of dipped over here. This was in 2009 or whatever. And then we've been sort of steadily going up. Here's the little blimp in March right here. And we're right back on up. The buyback spree doesn't seem like it will end anytime soon. As long as you're a company that is earning money greater than your borrowing rate, you can just keep borrowing and buying back shares. Both Joe Biden and Donald Trump have both spoken about the against the practice. So here you go. So you're now learning about what's going on. What they're doing is the same stuff that I'm saying. Hey, you watch the smartest guys in the room of what they're doing, and then you do the same thing. So what are they doing? Let's break it down based off of just a couple of pieces of information that we were able to see, learn, and read here only on Money Matters. And that is, rates are low, but people are trying to save. Well, you can't save on a negative interest rate, y'all. It doesn't work that way. I know that your gut says, oh my gosh, I gotta save, I gotta save, I gotta save. And if you're going to save, save in assets, okay? Rates are low, assets are bubbling up. What are the smart guys doing? They borrow low, they buy something that keeps on chugging on up, right? Then they use the profit from the chugga to pay down their fixed low rates. What does that sound like? Well, that sounds like a couple of different things, right? Now, would I do that necessarily with equities and stuff? I don't know. Probably wouldn't trade the equities on the margin. Definitely wouldn't do it. Done it once. Don't recommend it, especially not nowadays. And unless you're super experienced and know what you're doing, right? But if you're able to buy a stabler asset, right, that provides you with income. Think of potentially a rental property, right? Now, I know there are risks there, okay? I get it, fully get it. I'm just using this to get your mind to start thinking of what you could do, how you could potentially mirror what the smartest guys and the companies are doing so that you too can benefit from where we are right now and where we're heading, right? So if you're able to borrow for an asset that can potentially hold on to the 90% of the value, let's say, right? Like they might drop 10%, maybe more, who knows? You never know. But let's say, and you're able to borrow below 2%, so really, really cheap money that you can get. Then you get an asset, and then that asset produces 20, 30, 40% return on your money. Does that make sense? I would say absolutely yes. And it's just a new way to start thinking about. So many people think about, you buy an asset, you hold on to it, the asset goes up in price, and then you sell it. Well, while that works and that's fine, I guess, it's not the way that I like to think about investing or invest. I like to think about a way of, I want to buy an asset and hold it for forever, but I want this asset to pay me along the way, right? To provide me with a passive cash flow. Because if I am able to collect 20 assets and each of them kicks passive cash flow my way, that means I have 20 different sources of income coming my way. Now, if those assets happen to also go in price, that much better, but it doesn't necessarily have to be, because I am working off of an income, not just appreciation. But having both is even better, right? It's kind of like, tea and cookies, right? Having a cookie is good, having a tea is good, but if you can have a tea and a cookie and maybe dip it into it, that's even better. That's kind of how I think about the whole thing. So just something for you to think about, because they're doing that. Now, they're not buying somebody else's stock. They're buying their own stock. So what are they doing? They're borrowing money. Okay, think about it. They're borrowing money, and then they're putting their money into their own business, right? They're putting money into their own business. Now, of course, they're public companies, and so when they buy the stocks, it actually lifts that stock price, which then gets the FOMO to kind of kick in. Now, if we're thinking about those things, then you potentially could start thinking of, well, wait a minute, how can I benefit from that stuff? And if you have a business, maybe you're borrowing for your business, but be careful. Obviously, you want to go in a way that you can actually, grow your business and do really, really well. So you want to make sure that there's income coming in on the other side of that debt, that is going to protect you so that you can pay it, and make sure that that income is higher than the debt repayment that you would have to do. So you're going to have to do a little bit of math. You're going to have to do a little bit of thinking. But of course, you can do this in many different things. I used real estate because it's super easy to understand. You can do something like this in cryptos. We talked about it yesterday with some of the like flash loans and that kind of stuff. Now, the loans are not as low as 1.875%, but there are lows. Now, the nice part about what the large companies can do, these S&P 500 companies that are buying their own stocks, is of what they can do is that they can basically borrow at zero. You and I can't do that, right? So we have a little bit more difficult way of doing the stuff, but I think we can mirror and mimic and try to, in some sort of way, follow in those footsteps, or at least start thinking differently about our money and wealth. All right, now I have two very, very important articles that I want to share here with you before we wrap it up for the day and go about our business in figuring out how do we do and implement all these things. All right, you ready? Here we go. This is one that is very, very interesting, and this doesn't exist in the United States, but it does exist around the world, and it's very, very dangerous. And the reason I'm pointing it out to you here right now is because what is likely coming to United States, and it's incredibly dangerous. So you're going to want to pay attention to this stuff. Highly leveraged forex trading is illegal in the US, but it's perfectly legal in the UK, EU, Australia, South Africa, and other jurisdictions. Hope is that you make a lot of money quickly with little investment. The risk is huge, and in theory, you could lose way more than the account value. Most traders lose money. Actually, 60 to 80% of them do. A CFD, contract for difference, is a contract between the trader and the broker. The security traded on online platforms is calculated by the price change of the underlying asset, in our case, a currency pair, between trade entity and trade exit. There is no expiration date and no time decay. A CFD trade never owns a trader never owns the underlying asset. So this is a pure derivative trade, synthetic derivative, that's it. No asset that you hold whatsoever. You're literally just gambling. That's it. Forex CFDs are mostly unregulated. There are some rules which limit in Europe that limit the ratio of 30 to 1 of major currency pairs and 20 to 1 for non-mergers major currency pairs. In South Africa, however, leverage can be as high as 2,000 to 1. 2,000 to 1. Of course, if you hit it, you knock it out of park. But when you don't, 60 to 80% of the time, it wipes everything. My partner Charlie says, this is Warren Buffett, right? Because we just talked about Berkshire Hathaway. Warren Buffett infamously said, my partner Charlie says that there's only 3 ways a smart person can go broke: liquor, ladies, and leverage. A CFD is highly leveraged derivative contract designed for retail traders where trading does not involve an exchange. Instead, the trading takes place over the counter between the trader and the broker. This is horrible, absolutely horrible. A CFD broker, Pepperstone, one of 36 brokers on the list, basically shows that 78% of the retail investors' account lose money, and they're doing this when it comes to England because they have to display it by the law that exists in EU. However, when you go to the homepage of Pepperstone that you get by default in the US, namely the Australia version of the homepage, there is no such disclosure because they have to. Check it out, y'all. Check it out. You see this? When you go here, you see where my mouse is pointing? They have to basically put it and say 78% of retail investor accounts lose money, blah, blah, blah. But then you go into the AU, Australia. Hello, Australia. Are you listening? All right, pay attention. Okay, now here is all these different brokers, and look how many actually end up losing money. This is crazy. Absolutely crazy. Now, if this can't be done in US, why am I bringing it up? Well, because we have audience around the world, A. B, there is something else coming our way. Traders will soon be able to buy CLOs and other risky debt products on Robinhood. What? Hello, folks, I need you to pay attention. If you have not watched the video where I talk about the risk of the CLOs and what they are, how toxic they are, and the fact that they will implode. They cannot not implode, okay? They will implode. I just don't know when. Could it be tomorrow? Sure. Could it be right after this video? Absolutely. Could it be, 10 years from now? Sure. Anything is possible. I don't know what, where, when, or how. However, these are incredibly risky, and I've done videos on CLOs explaining on what they are, how and why they're risky. There are many other videos out there on YouTube, so if you don't want to trust me, if you don't want to listen to me, listen to other people when they're talking about this stuff. This is incredibly risky, and when they peddle it out to people who don't know it and don't understand it, you know that the game is over, and they're looking to squeeze out the last little bit of money out of you and I, and then when it implodes, they will still make money. You will lose everything. All right, so we got to read this stuff because it's very, very important. So please do pay attention, okay? A few years ago, banks started looking for new ways to package and sell safe, high-rated CLOs and other products based on newly ascended leveraged loans. Lenders are facing a perfect storm. The Fed making a foray into corporate credit market, and Robinhood enabled retail traders to buy up tech stocks, Bitcoin, gold, or at least the ETF version of the gold. And ETF sponsors are basically saying, wait a minute, how can we make some money out of this whole thing? We need to create new products, right? Because when they sell is when they make money. They don't care whether you make money, they care that they make money. So they're going and saying, well, these Robinhood traders will buy just about everything, freaking idiots. So let's sell them a new thing. And, the worse news come out of it, the better it's going to be. So maybe I'm actually helping them along this way, trying to warn you. Maybe I'm actually helping what they're doing over here. And personally, I think it's criminal that they're doing this. However, I also understand that I am the one that said let people buy and trade whatever they want. But that also goes with the caveat that you got to educate people on what it is and transparency on everything that is being created. So it's a three-way street, I guess, not just two-way, three-way street. Do those exist? I don't know how you make one of those, but they should exist. All Robinhood established competitors have now adopted the form of business model of commission-free as commissions have gone out of fashion. The latest example of this comes via Janus Henderson, the 337 billion assets manager that just filed to launch a new ETF that will allow Robinhood traders to buy the highest quality AAA rated CLOs. Now, CLOs are similar to collateral debt obligations, CDOs. It's just that the CDOs were mortgage on the humans like you and I, and CLOs are basically leveraged debt on businesses, on companies. And remember what's happening with businesses? They're filing for bankruptcies. Remember what crashed us in 2008? CDOs. Remember how they say it's all AAA and they were going to the pension funds until pension funds lost all of our money? Same thing. Different title. Same thing, different title. Okay? Pay attention, please, please, please. Janus Henderson is planning a U.S. exchange-traded fund that will seek floating rate exposure to the highest quality CLOs. CLOs would package and sell leverage loans into chunks of varying risk and returns. Remember, tranches? Tranches of CDOs, they are very, very safe. You cannot lose with this. It only goes up. And then it crashed, right? The riskiest corners of the 700 billion CLOs market may be signaling trouble, but the highest rated tier tends to be in a safe space. No, we talked about it. In the case of AAA CLOs, it's a safe and low risk asset class. No, it's not. It's a high risk derivative. High risk derivatives. CLOs are high risk derivatives. Yields are fairly low on AAA CLOs in the first place, but if investors can earn 150 to 175 basis points of spread in a short duration asset, it can be attractive. Yields are fairly low. Okay, fine. 150 basis points basically means what is that? 1.5%, right? It's not, you might get more out of a freaking savings account. Okay, you won't. But what I'm saying is people are desperate for yield. I get that. But this is highly risky and is being peddled as safe, right? And then you also get like a low interest. I wouldn't touch this with the 10-foot pole. The foreseeable future could mean that the more than 4 trillion U.S. ETF market sees a spate of launches like the fund plan. Given that yield suppression is here to stay, it would seem you'll probably see a lot more of this. CLOs are a cousin of collateralized debt obligation, which became notorious for their starting role in the 2008 financial crisis. There are several major differences, however, not least that the CDOs bundle loans to consumers rather than businesses. CLOs go into the businesses. The only real beneficiaries, okay, if you don't believe me, then believe the article that I'm reading for you, okay? The only real beneficiaries of this product will be the fund sponsors who collect management fees, the high-frequency trader firms who front-run the order flow in the underlying CLOs. That's it. Those are the only winners in this entire thing, okay? So this is what I want to end it with. I probably should have started with this warning nonetheless, but I reward those that stick around, and you stuck around, and I thank you for that. This concludes today's episode. Thank you for watching. Smash that like button, smash the subscribe, because tomorrow I have extra additional news that we didn't get to cover today, and we're going to be talking about how the Fed is going to send you money directly in the future. There's a plan in the works, and you should know about it. And of course, we're going to see additional news that are happening around the world. So thank you for watching. Those watching live, we're going to obviously do Q&A right now. Everybody else, thank you very much. Feel free to put stuff in the comments. I do read them. I do respond. And if you do have questions, I will do a video, maybe, potentially. I don't know. So I will see you tomorrow. Until then, stay forever money blessed. Do click the subscribe button. Do smash that like one more time if you haven't already. And stay forever money blessed. Until next time. And remember, you are only one deal away.